All right, everyone, welcome back to another episode of the Economics of Real Estate. I'm Dylan Silbernagel. That's Matthew Gizzi. It is the beginning of January, and we are starting to wonder, everybody's wondering, what is 2026 going to look like for the housing market? And so in this video, we didn't want to just take a look and make some predictions about where we think pricing is going to go or where we think sales volume is going to go. Is it going to be a buyer's market, seller's market? What we wanted to do was break down the data to show you everything that impacts the housing market. So what Matt has done today is he's taken a look at 13 different indicators, pillars, if you will, that will impact the housing market. So Matt, I'm going to throw it right to you, buddy. And let's get into this today and see if we can help educate some people on what's going on in the housing market. There is no major news headlines here. It is just simply looking at the data. Is this pointing positive, negative? And as we talked about on our market update the other day, it all depends on your perspective and where you sit in this market. Positive news for one, maybe negative news for somebody else. So while we do have this kind of ranked in terms of positive trend lines or negative, remember at the end of the day, how you are impacted in the housing market is different than everybody else, or on an individual basis and neighborhood by neighborhood basis. So let's take a look at it, Matt.
Yeah, and that's a great point. I think a lot of people likely follow us from the GTA Southern Ontario market. We are seeing pockets of areas in Canada that are doing quite well right now. The market isn't tanking on them. Didn't go through such a big transition as we've seen in Vancouver, Toronto, some of the big metropolitan cities. So keep that in mind when we're talking about this economic data, that yes, some of these indicators might be negative. It's not affecting the country as a whole. It's affecting certain areas more so than not. So this is kind of my 2026 housing cycle framework. I'm a data guy. I like my stats. I want to know what's under the hood, because what's under the hood is going to tell me how the economy is likely to perform going forward. Now, that's not to say that any of this data can't change, but these are all the pillars that I follow, and I want to see a broad change to show me that, okay, you know what, we're heading in the right direction or we're heading in the wrong direction. What's it going to tell us? So basket one is our leading indicators. These things typically turn first. These shift before prices and sale, giving directional clues about 16 to 18 months out. And the biggest one on here is interest rates and mortgages. So we've peaked out in interest rates. They've rolled over, but they've come down to a point where, the Bank of Canada policy rate and the 5-year government bond yield are still sitting at highs that we haven't seen since 2009, 2010. And, that has an impact on the ability for individuals on the cost of money, really, that they're borrowing. It's still relatively expensive from what we've seen over the last 15 years. Maybe not historically, if we're going to go back to the early 2000s into the 90s and the 80s. But it is still quite costly, and at the levels of debt that we have. So we do need to be mindful of it. Now, the mortgage spread in this can definitely fluctuate, the interest rate that one's going to pay on their mortgage. But right now we are sitting around the 4% range, give or take, depending on who you're getting a mortgage with and for how long you're getting it with. The second pillar in this basket is the credit availability and lending rules. So sometimes the lenders will tighten their rules when they feel that the risk for lending is a little too high. They're worried about the people that they're giving money out to. They're worried about the economic conditions that they're seeing in the market. So they will start to tighten some of those rules. We know during very hot markets, they seem to be throwing mortgages out to everybody. And right now they're being extremely selective to a degree on who they're giving these mortgages out to. And that will definitely depend on the lender. Some of the big six banks might be a little bit more forgiving, but if you're getting into some of the B lenders or private mortgages, stuff like that, they are super tight with the way that they're giving out mortgages. And also the stress test. The stress test gap is in play. I heard talk that they might revisit that. I don't know if they will or not. I think it's a good thing to have in there. I think it kept a lot of people potentially safe during such a spike that we saw in interest rates after the pandemic. And that might be one of the big reasons that we haven't seen a massive slide in delinquencies
Hmm.
in in the real estate industry, because if those weren't in place, I think people would have taken potentially, at least in that short time frame where the market really got carried away, um, they would have potentially put more on their plate during that time. So I do think it did its part during the pandemic to potentially keep some people safe. And then we look at the last market pillar, the market psychology and the expectations, right? So what's buyer, seller, investor behavior happening right now that we're seeing? Well, we know that buyers are being very cautious. They're being super selective. They're not rushing into things if they don't have to. Some people just need to make moves in life, and we're seeing those transactions happen in the market. But there's also a buyer pool out there that's sitting there saying, hey, maybe I'm in a condo and I can't move up. Maybe I'm in a townhome and I can't move up just because their prices have come down, or they're not feeling confident enough in the market to make that move. And then sellers as well. What's the seller behavior going on right now? We're seeing a lot of sellers that are unrealistic in the price points on their properties, and they're sitting on the market for longer. And we're also seeing that the absorption's just not happening in the market for buyers stepping in to buy, and that's what's having the active listings starting to pile up. Is we're just not having that absorption take place. So we're definitely seeing the sales to new listings ratio weaken into a buyer's market, a solid buyer's market. And consumer confidence has been affected because of a few things. They're seeing that unemployment starting to creep up. They're worried about what's happening with the trade relations with the United States and Canada. We've got a lot of manufacturing jobs in Ontario. And to be frank, Ontario is very dependent to a degree on the United States. So I think there's a lot of people that are watching the news. They're seeing some of the negative stuff out there, and it's having a big effect on where they want to go with the market. So, in order for these three things to really improve, interest rates and mortgage rates, I think we still need to see those come down. But from all the indicators that we're seeing right now, we've potentially bottomed as to how low interest rates are going to get. So we need more wage growth to happen to fill that affordability gap, and we need prices to come down potentially a little bit more for it to start to make sense for people. Because if interest rates aren't going to be doing the heavy lifting, then we people's paychecks to go up and affordability on the prices of homes to keep coming down. So that pretty much sums up basket one on that end.
And so, Matt, when we're taking a look at this, I love that you've broken it down and first explaining like what are the drivers here and then how we're tracking it, right? And so then at your bottom, the bottom part of our slide deck here, can you just go over that one more time and just kind of summarize what we're seeing in those three pillars?
Yeah. So, rates, they've peaked and the bias is easing. So, we hit those highs in the market. The rates have rolled over. I don't think that we're going to get any lower on rates unless something happens in the market that might be a negative thing. That's possible. There could be something that breaks geopolitically in the world, in some other foreign country's bond market, or even our own bond market, in which that happens. Or the central bank is going to have to start buying bonds to help get those interest rates down. As far as the bond market's telling me right now, we've bottomed in interest rates. It's up from here, not down. As far as when it comes to the credit, it's tight, but it's stabilizing. So the banks and the lenders, they want to see a little bit more confidence in the economy as well before they start loosening their
Maybe lending policies a little bit.
yeah, their lending policies and stuff like that. So we still need to see that. And then the psychology, where's the confidence in the market right now? And that's going to have one of the biggest factors of where this market goes this year is, do we see confidence in the buyers to say, hey, you know what, I've got the money for this, I can afford this, I'm ready to get back in because I'm confident that a year from now things are going to be better than they are today. And really what drives the low confidence is some people don't think that next year will be better than this year. And that's what we saw in 2025. They didn't think that the following year was going to be good, so they didn't jump in. So that'll be one really key thing to look at. Where is consumer confidence heading this year?
Okay. And so when we take a look at the next basket here, I see things like affordability and household cash flow, employment and income, investor economics. And I think one of the important reasons why we're breaking all of these down is because when we did our report the other day for the overall market update in January, we read the statement there from Treb saying that the market is poised to rebound. Affordability is getting better as we talk about interest rates coming down and pricing coming down. But they were just looking at it through that one lens, right? There are other aspects of how affordability and housing work for people, right? Are we having affordability issues outside of housing as well that will, of course, then impact our housing? We've talked so much in the last couple of years, really, but I think it really came to a head last year, especially with the trade stuff, as we talk about the cost of items and goods, and specifically groceries. There's been a couple of headlines out there talking about how much grocery prices in households are going to go up. So this is some of the stuff that we're breaking down here, Matt. So I want you to walk us through it again. Talk about what the pillar is, what it does, just briefly kind of how we're tracking that, but then really tell us what are we looking at as we get to that bottom down, the position for 2026. That's what I think we really want to know.
Yeah, it's interesting you bring that first part up because RBC came out on January 6th with an article on Canadian affordability crisis to continue through 2026. And I'll just paraphrase from what they said. The Canadian households saw their wages grow faster than inflation, but those gains failed to keep up with the essentials. That was the take from RBC in its 2026 outlook. Noting that the cost of food and housing continues to outpace incomes. So when Treb comes out and says that they're starting to see some room there, well, to a degree, but a lot of things went up in price and quite a bit in price. And we are in a bit of a K-shaped recovery too. So you have to factor in that when we talk about the housing costs continue to outpace incomes, that has to do with mortgage rates, but it also has a lot to do with rent. And, anyone trying to rent in this market is paying a lot more than they were 5 years ago. Anyone having to switch from one rental to another one is getting a large payment shock as well. So that's always something you have to factor in, even though we're looking at, the overall market. So when you're talking about affordability and household cash flow, it does come down to the buyer's capacity and their bid power in being able to purchase. How much I've seen charts where the savings are there. The savings in Canada are there. So it's not that people have been burning through their savings. They have kept pace with what we've seen in prior years. So that is a good one. So when we look at unemployment, income, and momentum, we just had the statistics come out today from StatsCan, and we did see the unemployment rate go from, I believe it was 6.5 to 6.7%. So the last couple of months it was starting to roll over, but we did see an uptick back up to 6.7. But one of the big reasons we saw that is because the participation rate started to increase a little bit. And I think what's going on there is what we saw was a lot of students that came to Canada, foreign students, are potentially starting to go into the jobs market now. Semester one for this year is over. Typically, students will finish up a few things in the first semester, and then they're out looking for jobs come the second semester. So it is possible that we're starting to see an increase in those individuals starting to look for jobs. So it's not that we're actually losing jobs in this report, it's that more people are looking for jobs. And that could be some retirees as well, because the cost of living has started to increase and they're starting to come back into the market. Now, that is just a small little increase that we've seen. It typically chops around, so it will be interesting to see how February and March play into this as well. Another one is, the supply pipeline and the resale inventory. Trade with the U.S. has been struggling this year. And a lot of it has to do with the tariff side. We're actually importing more than we're exporting right now, and have been on a month-to-month basis for most of last year. So we want to see that we're exporting more goods than importing more goods as well. And then we're looking at the investor economics. Investors are looking at properties and they're saying, hey, like, what's the cap rate? Is it cash flowing? What's the sense there? And it's hard to, as an investor myself, looking at, sure, there's always going to be a property that makes sense. But to have a dramatic change in the market, you need investors to come back into the market to either start buying your duplexes, triplexes, fourplexes, and of course your condos. Nobody's touching condos with a 50-foot pole. And we're not seeing, at least in my business, a ton of investors coming to the table and saying, hey, Matt, I want to be buying investment properties because I think it's a great place to put my money right now. Rental market conditions, like what's going on in the rental market condition. And that has a lot to do with what investors are going to think about as well, because right now we're seeing rental prices start to fall. We're not seeing we are seeing a massive influx of rentals hit the market, but we're not seeing the months of inventory spike. They're typically sitting between 1 and 2 months. So yes, we're seeing a lot come on the market. We are seeing a decent amount of absorption, but not to the degree that we've seen before, which was typically, half a month to a month or even less, which was helping drive the prices up. So we are starting to go from a month to 2 months, which is having prices start to roll over. So you typically, as an investor, or there's a lot of speculators in the market, they might not want to chase something that's rolling over in rents right now. So that's another thing to keep. That can have a floor basically on the investor demand. And then the last one is your policy, your taxes, and your regulation. So your land tax, development charges, rental property. So Toronto actually came out with a very low property tax this year. Now it is an election year for Olivia Chow, so she could be keeping that low this year, seeing as how I believe she's raised property taxes 30 to 35% during her term. So she's already done quite the job of bringing them up. But she might be holding them back this year to get elected and then increasing them potentially up to 5-6% next year to make up for the gap. And then what are we kind of seeing from our federal government? Well, they have lowered some people's taxes with their income taxes. So there's a little bit more money going into the economy there. But when it comes to development charges, that's been a huge issue that we've seen. Some municipalities are starting to scale those back, but not everybody has. And I think that the governments need to focus a little bit more on getting those costs down, because those costs really accelerated during the pandemic. And I think because of ultra low interest rates, it was easier to hide those costs in the property, building a new property, but not anymore. The cost to build, the cost for labor, has accelerated quite a bit during the pandemic. So you can't hide these development charges in there any longer. So something is going to need to be done with that. And will it result in even higher property taxes, or will the federal government step in and pay for the gap in between those? So really, at the end, cycle position for 2026, affordability tight but improving with easing rates. I think rates have eased. If anything, it might, on the bank side, they might start to ease rates a little bit, their spread a little bit more. Employment, it is somewhat stable. It was slightly easing heading into today. But at the same time, like I said, I think people are coming out of university from everyone that came through over the last couple of years. They're starting to look. Those people will either find jobs, or they might just end up packing up and going elsewhere. When it comes to inventory, we're still extremely elevated in inventory, at least in the GTA, York region, Simcoe areas that we cover and we do these videos. Investor math is not making sense in a lot of cases. There's still some good deals out there for some investors, but broadly for the investor slash the speculator, it just simply doesn't make sense at this point with the rates that they are and the prices that they are and the rents heading in the direction that they are. And then policy, it's still it's still chunky, it's slower to move. There's a lot of things that need to be ironed out this year to get the ball rolling again on that.
Yeah, and it's interesting because some of these indicators, like we talk about these being transitioning ones, they are changing a little bit more frequently than, well, obviously what we're looking at leading or lagging. But it's interesting because a lot of that boots on the ground stuff, we see that in terms of inventory. It's something that we're watching, especially for our sellers on a weekly basis for their neighborhoods, for their local markets, right? What's our competition look like? If there was 10 available last week and 10 more hit the market, now there's 20, but we're only selling 3 or 4 of the, or buyers are only buying 3 or 4 of those a month in that neighborhood. That's why we started to see that inventory, those months of inventory start to stack up. And when we see those levels rise, that's why we talk about a buyer's market, because they have so much choice. What these indicators, these baskets that Matt's brought up today, is giving us a deeper look at everything that's impacting there beyond just, hey, what's supply and demand doing for us this month in terms of real estate? All right, Matt, talk to me a little bit about the lagging indicators that we're looking at.
Yeah, so these respond after primary cycle shifts. So these are going to respond after basket one, basket two, and they kind of help solidify that the recovery, like they define the recovery extent and the potential duration that we're going to see. So the first one on this is population growth and the household formation. So what are we looking at when it comes to the population growth? Well, we know that in 2025 in Canada, the population actually shrunk. And this had a large part to do with the immigration policy was tightened up quite a bit. The foreign students, temporary workers was tightened up quite a bit. And also a lot of people went home. A lot of people couldn't afford to be in Canada. A lot of people came here through the universities. The jobs just weren't there after. The affordability was not there. And they ended up leaving. And a lot of these people were based in Ontario. Let's face it, when you come to Canada, I think a lot of people dream of living in Ontario or potentially BC. Sometimes they have to start in Edmonton or start on the East Coast, and then for a couple of years, and then they typically will trickle to those places, unless, of course, they fall in love with where they went in the beginning. But we do get a bulk of those individuals, and they start to go. When it comes to household formation, we know that the household formation is struggling. People aren't having kids like they used to. A lot of this has to do with just how expensive it is in a lot of these in Ontario and BC. Can you afford to have a child when you're paying this for a property, this for a car? You're really right up against there. Canadians are paying what, $1.71 of their income towards debt. And it's hard to have children when you kind of owe that much debt as opposed to your income. So we're not seeing positive signs when it comes to population growth and household formation. New construction and completions, it doesn't take much to look around and see that they're not building a lot. We're finishing up condominiums that were already purchased. Those are going to be fun to watch over the next year to see how many people close on them. I've actually had conversations with quite a few people who've said, hey, listen, I know a guy that purchased this condo. He's just walking away. He's losing his $20,000. I said, he's going to get sued as well. He's like, yep. He's like, what can he do? He can't close on it. And those have been multiple conversations, and I'm only one agent. And they're not starting new projects. They are in some areas, don't get me wrong, but it's not to the degree that we've seen since 2014, 2015, where, you could drive down any road and anywhere that there was a new subdivision, condo, and there was lineups around the street of people wanting to rush in to buy these properties. And you're not seeing anything close to that right now. So that's definitely something we're not seeing. And again, these are late stage pillars that you're typically talking about. So this is something we will see near the end as, okay, like everyone's piling back into the market. And then when we're talking about, distress and forced selling, which is, how many people are in arrears for rents and stuff like that, and also arrears for their mortgages. How many people are going through power of sales right now? How many people are going through bankruptcies, consumer proposals, and then also the renewal stress. We've had the most amount of mortgages in, Canadian history, basically getting refinanced 2025, 2026, and they're all refinancing into much higher payments. Not all, but a decent majority of them are, and they're typically more than 10%. So there's stress in that market as well. These are things that are continually climbing. They're not peaking out, and they're not rolling over right now. And then looking at the local macro fundamentals, what are the local municipalities in our areas that we're looking at when it comes to York Region, when it comes to Simcoe, when it comes to Durham, is that these markets are still struggling. We're starting to see a lot of stuff pile in the market. I was just looking today at how many sales have been done in the basically Southern Ontario market, and sales are down 41% this year compared to last year. So we're not seeing buyers hit the market. Now, one good thing that I saw was that new listings are down 3% as compared to last year to start the year, which is good. I thought that we would see a little bit more rushing to the market to start, but that's not the case. But active listings to start this year compared to the start last year, the first 8 days, is up 13%. So we are seeing, when we look at the local kind of macro fundamentals in the real estate market, there's still some tightness there. So cycle position 2026, population, you want to see some strong secular growth. But I don't think we're going to see that this year. I think we're going to see a lot of what we saw last year. Now, again, the government can always step in and say, hey, you know what? Foreign buyer ban is over. We're bringing more people to the country. And let's be honest with ourselves as well. Canada has no choice but to bring more people to this country for the one reason that we have population, and we need to backfill it with individuals that can pay for the CPP, pay for the medical expenses that are going to be coming. It's nice to give people free things and promise people free things when you have one of the largest cohorts of your population coming up, like the baby boomers did, like we've never seen before. But now they're all starting to retire and age, and they also are needing the medical system more than ever. So that's going to put strain on the society unless we start bringing in a lot of people to backfill that, and to be able to make sure that the taxes and the GDP is high enough to support these costs that are ultimately going to happen. And then when it comes to building completions, like I said, still very, very slow. We need to see that to come back before anything changes. Distress needs to start to roll over. We're not seeing that. And then the micro fundamentals in the communities, we need to see definitely the housing market start to be appealing again. We also need to see job growth and investment in those areas as well, so that it gives people confidence and to get back into the market, really.
Right. So, Matt, let's give it a quick summary, kind of a Cole's notes. And again, we always put chapters in our videos, so you guys can jump right to this at the end if you ever choose to. Keep that out for the next video. Of course, don't miss out on all the insight and conversation that comes along with it. So, for those of you that have been watching, here is the scorecard in terms of how we're looking at that. So, Matt, can you share real quick what stands out to you on here? What do you think some of the key takeaways should be for people that are wondering what we're going to be seeing when it comes to 2026?
Well, I mean, at first glance, you can see we've got nothing in the green right now. Green would be indicators that are moving in the positive direction. Not that they're moving in the positive direction, but they're in that positive framework where we're going to say, okay, you know what, that pillar is in the place that we want it to be in, to kind of give us the broad idea that it's doing its job depending on what basket it's in, right? But there is a lot of red on this board. So we'll start off where we're seeing the most weakness. That's in affordability and cash flow. That's in the employment and on the income side. Again, like I said, yes, we've had income up year over year at 3.4%. The problem is a lot of the primary things that we spend money on every year in the CPI basket has gone up quite significantly as well. And that's eating into that growth that we've seen on the income side. Then we're looking at the population in households. That's going negative right now. It's not going into a positive direction. Supply and active inventory. Again, that will be a story for later on when things start to stabilize and the housing market starts to move up and we start to bring more people into the country, and 2027 we start to allow foreign buyers back into the market. We're not building basically a lot right now, and we will feel that pinch down the road. But as of right now, not now. Number 8, investor economics. It's negative. It's not appealing to investors right now. Again, in the areas that we cover, which is the York region, Simcoe, Durham, GTA markets. And then policy and regulations is negative as well. And then when we're looking at interest rate and mortgage rates, that's neutral to easing. So we are starting to see, we did see an impact on that. Construction and completions, again, neutral. Credit and lending rules, neutral. Rental market, neutral to weak. It is weakening because prices are coming down. And the vacancies are climbing. And I think they will start to climb a little bit more into 2026 because there's still a lot of purpose-built rentals in the pipeline that are getting completed. So we'll be definitely keeping an eye on how many of those kind of enter the market this year. And then when it comes to distress and the forced selling, we are seeing the largest refinancing in Canadian history for 2025 and 2026. A lot of people, especially for the second half of 2021, were purchasing homes and refinancing when properties were at their peak prices. So those individuals will be potentially struggling on the price of their property has lost significant value since then, and then B, how much of an impact on their monthly payments is there going to be. So that stress potentially will take some time to work its way out of the market as well. And then we're looking at the psychology in the market as well. What's consumer confidence looking like? It's not looking that great right now. A lot of that has to do with the U.S. market, what's going on with Donald Trump. And you know what? It has the chance of getting a little bit worse this year. People are worried about what he did with Venezuela. People are a little worried about what he's saying about Greenland. If you think that he's done with talking about Canada, he's not. My prediction for this year is he's going to talk about Saskatchewan and Alberta, because let's face it, does a Republican Party want Canada? No. It's far too left-leaning for them to want it as a whole. They would ultimately want the conservative states, or the conservative provinces, which ultimately have all the resources that the world actually wants. And so will he ultimately get those? Probably not, but the rhetoric will be there, and it will likely have an effect on consumer confidence, unfortunately, I think. And then number 13, the local micro fundamentals. Those just aren't there, and it's tough on my end to see them potentially recovering until we see a lot of these other pillars start to recover first. So the total score was a -4 out of 26. So neutral to negative bias, stabilization, but definitely not recovery. And even though you can still see prices come down and activity come down from here, it can still be a stabilization type scenario there. You just don't think you're going to fall off another cliff here that we saw last year in some pockets, especially the Newmarket Aurora area.
Yeah, I think we're still seeing those fluctuations. Like we said, it felt like going from 2024 to 2025 that recovery was really beyond stabilizing. We were entering into recovery because 2024 had outpaced 2023 in terms of that sales volume and people being able to make those transactions. Forecasts were positive that was going to increase. Obviously, everything south of the border probably had the biggest impact on that. And we saw quite the opposite, down 10% as opposed to gain, right, in terms of the sales volume. So I think that if we start to see some positive news in some of these different brackets, like, of course, affordability is always a big one, employment and income's a big one. Supply and active inventory, I'm not as worried about that right now because the supply means choice for buyers. We just want to get more people back into the market to start being able to take advantage of that and build on top of it. So if we see that, then I think what's really going to start to happen is our buyer, like the market psychology, is going to make the biggest impact. And once that starts to change, people can feel more confident in making those decisions. And once that happens, everything goes in that positive direction in the sense of like people are able to make those moves if they choose to. And obviously home ownership is such an important thing that we pride ourselves on here in Canada. So something that we want to remain healthy. And while some of the scorecard doesn't look great, what it still does mean is that there's lots of opportunity out there for different segments of the market to get into home ownership. Obviously, affordability being a big part of that. So we'll see how much those other sectors of affordability outside of housing continue to impact us. But the goal there being that we have more people that are able to enter the housing market, I think, at the end of the day.
I think we're from now on every month we're going to kind of highlight just the overall picture of the scorecard. So this screen will actually we'll show the three baskets and we'll do the kind of color coding next to each one, so that people can see when the transition starts. Because I think it's super important for first time home buyers, investors, and also move up buyers, people that are already in a condo, maybe in a townhome. When these things start to shift in the right direction, that's when you want to start taking advantage of these opportunities. Because if you're a move up buyer, do you want to take advantage of an accelerating market in a condo or a townhome or a detached? Same goes for if you're in a townhome. Would you rather ride that wave up in the detached as opposed to the townhome? And then as an investor, you want to get back into the market when things feel like they've bottomed out, indicators are starting moving, because this is where the real money is made in real estate. This is where people can put a lot of equity behind them. It's not going to the market and buying when everyone else is buying. It's getting in smartly before the wave of everybody else starts to jump aboard. And that's why you guys follow us. That's why you follow along, because we try to give you this type of value to show you when a good time is to definitely start to relook at the housing market. If you are one of those individuals that's sitting on the sideline and waiting, don't wait too long. We've already seen so much pain in the market, so much get dragged down in the market right now, that we're not expecting another massive leg down when it comes to prices. I think we're still going to trend downwards, but not as violently as we've seen before. So definitely keeping an eye on these are going to give you a great insight of when maybe it's a great time to get back in.
Absolutely. We've seen prices now. We're almost at a 5-year discount in terms of the reset that we've seen. It's a great opportunity because it doesn't come around in terms of these market cycles very often. What it does mean, though, is you still need to be smart. You need to take the time, have a great consultation with your agent, with your mortgage broker, find out if now is the right for you. And if you can, take advantage of that pricing, because in terms of how we set up, a lot of us are set up in Canada, this smart move now could mean great future potential in terms of your retirement, in terms of those house value, the equity that you get coming out of it. So it's something that you need to be talking about. And that's why we're doing this, just so that you can start having that conversation and make plans that are suitable for you. Thank you so much for joining us today. I'm Dylan Silbernagel. That's Matthew Gizzy. We look forward to seeing you guys next time. Bye for now.
See ya.